people. That had to be about 1967 for sure. Another flashback here on the Ray Show leading up to the Valentine's weekend for many. 844-729-7469. Lyn Rowe joins me on the program, certified financial planner. Lyn,
yes, sir.
Did you happen to hear any of the stuff I talked about before the break?
I did.
All right, so you as a CFP would know exactly where I was going. I'm reading this survey from Fidelity that says advisors' biggest concerns are rising interest rates. And I'm saying to myself, man alive, I've got to have like 1,000 other concerns if I'm an advisor than whether or not interest rates are going to rise. First of all, they're not going up by a ton. Anybody that follows the news at all, the economic news, as good as it may seem to people, they're not going up a ton. So a tick up here, a tick up there, yeah, it'll have some minor impact. But that's not my concern, and I don't think it's your concern. What's your number one concern? As if I didn't know.
Well, my number one concern is that people aren't being more careful than they should be. Frankly, people are just getting used to this market being something really exciting and pretty much relying on it. And what they need to be doing is looking at the safety side of their portfolio and protecting themselves in all aspects, whether it be health concerns, longevity concerns, as you were talking about earlier, because let's face it, the longer we live, the more likely we are going to become frail at some point and need help, and that's where extended care planning comes in. And just protecting themselves against the unforeseen.
Yeah, so really, when you start looking at the so-called pyramid of risk, the risk of rising interest rates doesn't appear anywhere near it, the top of the list in my mind, to be honest with you. But certainly post-retirement health care issues is way high. Longevity risk is way high. Market risk is way high. Now, to their credit, market volatility, they said, was the number 2 concern of advisors. I'm less concerned about volatility than I am just outright crashes and secular bear markets during a time when I need to start taking money out of my retirement account.
Well, things happen with your portfolio that you can't predict. I mean, a simple thing like today, we're hearing about the possibility of going to war on ISIS and actually declaring war. That's the kind of thing that makes the market nervous sometimes. That's where your portfolio starts to have those kinds of crashes.
Okay, so let's talk about let's identify the risks in order of importance. And everybody's order of importance is a little different. But the way I was always trained in the financial planning business is the number 1 risk is death, dying too soon.
Yep.
That's pretty easy to manage as long as you're insurable.
Exactly.
Especially at a young age, it doesn't cost that much. So you insure against death by buying a life insurance policy, or being Bill Gates and having enough money to finance, you and every foundation in America if you needed to.
True.
But unfortunately, I don't have as much money as Mr. Gates, so therefore I have to be concerned about dying too soon. The second risk is healthcare concerns.
And conversely, living too long.
Right, which sort of go hand in hand, because living too long eventually potentially creates a healthcare concern, doesn't it?
Absolutely. You know, the fastest growing segment of the population now, Ray, is over 85.
Yeah, I do know that. And in fact, people are living longer and healthier, I might add, with modern healthcare science and so forth. So that's the good news. But sooner or later, most of us do run out of steam.
Exactly right. And the longer we live, the higher the likelihood of becoming frail in those later years. And frail doesn't necessarily mean poor health. It just means that you can't do some of the activities of daily living that you used to be able to do just because of the aging process. It's just that, simple fact. And so for that reason, having some sort of extended care coverage where you can actually get help without having to become a burden on the family, so to speak, or relying on friends and just trying to figure it all out yourself or trying to do it yourself is important. It's a huge part of planning. And so that's why we talk about it every week.
All right, so here's the issue, okay? When you talk about health care, for example, and in particular if you're trying to insure your health care, like with a long-term care policy or something like that. There are a lot of people that wait. They wait too long and they become uninsurable, or they have diabetes, or something happens where, based on the prior statistics, and I have some in my head from way back in the olden days when I ran a company, as you know, that focused on healthcare. Back then it was like 30%, 35% of every single long-term care application was declined. Is that still about the case?
There are a lot of issues with getting the coverage for many folks. For example, the people between ages 50 and 59, we're seeing about 20% of them being declined. 60 to 69, it's more like 25%. So age brackets have a bearing on it, which is why I try to get younger people to think along the lines, people in their 40s, for example, and early 50s, think along the lines of getting coverage now, because number one, even if you go out 20, 25 years, Ray, we've done the math. You save money.
Oh, there's no question about it.
Yeah.
The problem is getting people motivated to do it, because nobody wants to part with the almighty dollar today, not recognizing that from just a pure investment standpoint, it's not bad if you end up needing the care.
Exactly.
Now, if you don't end up needing the care, then you had to take a small percentage out of your portfolio today to mitigate that risk. But we do that every day. We do it with health insurance, we do it with car insurance, we do it with fire insurance, we do it with all kinds of insurance, some of which are mandated by the states or the government.
Right. Well, the homeowner's insurance is something that most people do at least their whole lives, 30 to 40 years. Once they buy a home. But even after they pay off their home, many times people will keep the coverage. And we saw this many years ago, Ray, when we had fires here in San Diego, where people had thought they were good because their loan was paid off, and they let their insurance lapse, and it backfired on them. So a lot of people these days don't do that anymore.
Let's not remind me of the fire which actually took my home that I raised my kids in. Fortunately for me, I had already sold it.
Yeah.
But the people that bought it was a fine family. It's a big, huge family. And the woman was actually extricated from the home at 4 o'clock in the morning, not realizing that her roof was on fire.
Oh my gosh.
And the firefighters got her out just in the nick of time. The house, of course, burnt to the ground. And it's scary stuff. When you talk about insurance protection for things that probably aren't going to happen to you, but you still have to insure against it. The fact of the matter is, I don't know what the odds are, you probably do, of your house burning down.
It's way low, Ray.
But compared to having some kind of a long-term sickness, illness, catastrophic, chronic illness, whatever, big difference. Stick around. Lyn Rowe, by the way, her website, iwantmyltc.net. You want to contact her because she's the world's expert on all this stuff, besides me, of course. She's the one that taught me everything I know about this stuff. Anyway, we'll come back. And I don't know if you heard the story about the world's oldest supermodel.
No.
Going back to work. I'll tell you about it when we come back.
Great.
844-RAY show. There's still hope for you, see? You could be the world's oldest and shortest financial advisor supermodel back to work at age 83. Yeah, this is interesting stuff. Stick around, folks. 844-RAY show is the number. Lyn Rowe, certified financial planner, back in a flash, so don't go away. Lyn Rowe joins me back on the program. Lyn, what's the very first thing you learned as a financial advisor?
Manage risk.
Manage risk. Don't put all of your eggs
in one basket.
This woman did it, right?
That was Grandma's advice. Remember that?
That's right.
Yeah.
My grandmother, my Sicilian grandmother, she said, "Don't you put all of your eggs in a one basket."
It's true.
That's how she said it too, and she had to get the hand up like that. Anyway, we're obviously talking about managing risk here with Lyn Rowe, and of course, Lyn's area of specialization is managing the risk of health care.
Right.
You don't have to be 83 or 84 years old to be thinking about health care risks.
No, there are people, we were just talking about this on the break, right? There are 30-year-olds who have seen unfortunate experiences like heart conditions, cancer. I mean, those young people need to be thinking about some of these things too, because you know and I know that their deductibles went through the roof. Their co-pays went through the roof, and so now they're looking at these kind of circumstances and not being able to manage that risk because they're so young that all the money was basically going into taking care of their families. And so if they have time off that they don't have sick leave for, or they have expenses that go into, medical expenses that go into their pocketbook or their savings, that can be a real shock too.
All right, so the focus of our discussion today is centered around options.
Yes.
Because there are so many different options, and it's not just a long-term health care insurance policy or a life insurance policy with some kind of a critical care rider. You do all that stuff, and you do it as well as anyone. But I want to talk to you about my dad.
Okay.
All right?
Okay.
Now, he's not young. He's not a young person. We can come back to that. He's, I think, going to be 90. All right.
Okay.
We don't know, actually. We think, so he says he's already 90, but I'm fairly certain he's been lying to me about that. I think he's 89, going to be 90. In either event, he's still in pretty good shape, but I don't think you're insuring a 90-year-old for long-term care, right?
No, we have another option for folks, doesn't matter what age.
Okay, now he's perfectly healthy, except the mind is a little bit, weird, but
that's the key.
So is mine.
I was going to say it runs in the family.
Yeah.
But he, for example, if he is able to do those 6 activities of daily living,
Which are?
Bathing, eating, dressing, toileting, transferring, incontinence, those issues, if he's okay there and he is not in care, there is an alternative for someone.
So even though he couldn't qualify for traditional old long-term health care,
Yes.
there is an option. I don't want to get into the
is.
specifics because that's what I want people to contact you, because everybody's different. You want to go through the litany of options.
Yes.
But how does an 89-year-old that is still reasonably healthy, that can't get insurance? That doesn't make sense to me.
Well, technically it's not insurance. It is a plan that enables them to have care. And I can go into the details with each individual, but there are different packages that you can select, and that the package determines.
Okay, I'm sorry to interrupt, because I'm really interested in this. My dad needs somebody to sort of hang out with him a couple hours a day, because we're all working, and then all the kids, we rotate. Somebody sees them in the morning, and then we see them at night for dinner or whatever, but there's that middle 4 or 5 hours a day where he's by himself, and it's him and the 2 cats. And he's doing okay, but I would like to have somebody.
You're concerned about him being alone.
I'd love to have somebody there just in the event something were to happen. You see the commercials, I've fallen and I can't get up.
Yep.
He's still in pretty good shape that way.
Yep.
But can I buy services that way without?
You can. The thing is, you have to own the contract for a period of time. You can't do it, like the next day. But
There's actually a way for me to buy hours. Does it cost a lot of money? Because I was told that it cost like $21 an hour or $30 an hour for somebody.
It actually can save you a considerable amount of money.
Really?
Yeah, 60-70%.
60-70% savings off of that?
Yeah.
See, the reason that you contact Lynn, folks, is she has these tricks up her. I never even heard of this. Never even heard of this. And I spent a good deal of my life running a company that specialized, not running the whole company, but my own local company. I have run insurance companies, by the way, but this goes way back when I was your age. In either event, it's kissing up will get me everywhere.
A couple of good strokes there.
Yeah, I was just teasing her that's what she's going to look like when she's 83 in a couple years. No, just kidding.
Oh, are you in trouble?
That's my Valentine's gift to you. Lyn Rowe, certified financial planner. Listen, if you want to learn about this, you want to go to our website, iwantmyltc.net. iwantmyltc.net. Listen, I know we're short of time, but you're talking about options with respect to health care. One of the greatest risks we face today, this retirement crisis, baby boomers, 10,000 of us every day hitting retirement. Tell people how they can get a hold of you, because this is something that even if they have been turned down for long-term health care, you have options for them.
We have options. So we have options for people who've gotten their coverage, but they're concerned about their parents. That's a big one.
That is a big one.
877-270-3127, Ray.
877-270-3127. Or it's just as easy to remember, iwantmyltc.net. iwantmyltc.net. It's Lyn Rowe, certified financial planner. Thank you.
Thanks, Ray.
When you're 83, you're going to look like this Carmen, whatever her name is?
Promise, absolutely.
I think so. I think you're a little too short, though, to be a model. But in my mind, you are the model CFP when it comes to healthcare and long-term healthcare. Thank you so much for being with me.
Ray.